Mike, you used the phrase, and probably didn't, I don't know if you meant to or not, but you quickly used the phrase running out of oil. And with reference to peak oil. Can you comment on you know, in the lexicon, you spend time in Washington, D.C., can you comment on clearing up the vocabulary about what peak oil means and how it's being received there in discussions, particularly in D.C., because your team has spent some time there?
I think, you know, in terms of peak oil, it's not so much a question of running out of oil, because there, as you often hear, there is a lot of oil left behind in the development of a typical oil field. What you're really running out of more than anything else is the ability to grow rate or daily capacity. That's where the real problem is. Within Washington, D.C., I think that over the last couple of years, we have certainly found much more receptive audiences to this than we would have in previous years, and the audiences have been pretty high up. I mean, and not always well published, but there have been real efforts made on behalf of the administration to have people who are on both sides of this issue come and sit down with them directly and talk to them. They have, I'm very confident and sure that they have been trying to educate themselves on this problem. But that's only because of the high prices and the fear of what it would do to the economy.
For Mr. Hughes, first, and also for Mr. Rodgers, the first question, for Mr. Hughes, do you see any emerging attitude or growing attitude in Canada among Canadians against export of natural gas, given the circumstances of the decline? And for Mr. Rodgers, with respect to declining oil prices, do you see any shortage of supply on the horizon as a result of these declining oil prices?
If you look at the North American Free Trade Act, energy was part of the deal between Canada and the U.S. And there's a proportionality clause that states that we cannot, if we reduce our exports to you, we have to reduce our consumption by an equivalent amount, or an equivalent proportion. There's been certain left-wing think tanks, particularly in Alberta, who think that's a very bad idea, that we should repeal that provision of NAFTA as soon as possible. But as far as the Government of Canada goes, I think it's business as usual. It really hasn't come up kind of at a political level so far.
On the impact of oil prices on supply, a lot of the increase in non-OPEC supply that you're going to see between now and 2010 is going to come from projects that are already under construction. Most of these are deep water developments, large developments that require a lot of lead time in terms of doing your engineering studies and construction. I don't think a fall in prices is going to have a dramatic impact on the increase of the supply over the next few years. A lot of that's going to come from natural gas development, which is already in progress as well. Now, some of the projects could slip a little bit, and you could have some supply being impacted by other factors like constraints in the service sector. Right now, the service sector is completely stretched to its limits in terms of fabrication capacity, installation capacity, personnel, and this could also cause, it could trigger some delays in key projects, which actually softens out that supply picture. The other unknown and really the most important question is how will OPEC react to rising or falling prices, and will or will they not have the discipline that they've shown over the last couple of years?
I'm interested in finding out whether you know about the ease of switching fuel sources for power generating companies. I've heard about if gas gets too expensive, they'll switch to coal and vice versa, but I'm not so sure that's so easy to do. Dave, do you know anything about that?
It's really not that easy. You know, a coal plant takes probably 5 or 6 years to build. Coal can't really be turned on and off like gas. So as a result, The utilization of a typical coal plant will be over 90%. That's base load. The gas plants are turned on and off really to manage peak. That's sort of what they're good at. But in terms of high volume switching from gas to coal, I don't think so. Possibly between gas and oil, there are dual fuel generators that have been built and are available in the U.S., so there could be more switching from gas to oil.
Two-part question for Dave. On a new gas well in North America, how fast does it deplete once it's drilled in Canada and the U.S., and how's that different in a coal bed methane situation? And secondly, you showed a very low EROI or net energy on coal bed methane. Why is that? Is that because of the infrastructure to create it, the fixed cost, or is it once it's drilled, it's also very energy intensive to get the gas out of the ground? Thanks.
There's coal bed methane wells, and then there's coal bed methane wells. For example, a coal bed methane well in the San Juan Basin, some of those are very highly productive. You may get 2 million cubic feet of gas per day out of them, whereas the average well in Canada is 100,000 cubic feet per day, which means that you have to drill a lot more wells and connect them with a lot more infrastructure on the surface, which is why the energy investment compared to the energy we get back is quite low. That ERO-EI that I showed you for coal bed methane would be sort of a global view. It wouldn't reflect the San Juan Basin case, which is very unique. As for decline rates, if you look at traditional coal bed methane wells in the U.S., where they're dewatered typically for 2 or 3 years before they start to produce gas, the decline rates on those wells are very low compared to conventional gas wells. What we've been finding in Canada, however, is there's no water associated with the coal bed methane. They start producing gas right away, and they have decline rates much more like a shallow gas well. So Canada is very unusual in terms of coal bed methane by comparison to what you found in the U.S. But the overall decline rate in the U.S. is now 28%. If you take everything, coal bed methane and conventional. So all of that gas has to be replaced by more drilling every year.
Would opening up the outer continental shelf make a material difference to the analyses you put forward today? There's been talk of doing that in Congress. I was wondering if you had considered that.
I think it's, it could be an incremental contribution to a supply. It may forestall a plateau for a few more years. I don't think it's a panacea. I was at GasMart and somebody mentioned that, why don't we just open up the East Coast for drilling and find gas like those Canadians have been doing off of Nova Scotia. And it really hasn't happened. Sable, which is our gas producer off of Nova Scotia, is going to be dead by 2015. And we really don't have anything to replace it so far.
I was referring mainly to the U.S.
But in terms of what opening up the East Coast would do for you? Yeah, and that's what I said. I mean, you probably find some gas, but I don't think it's a silver bullet that's going to change things, for that many years going forward.
Mike Rodgers, you spoke about the Venezuela, I think you said heavy oil. Doesn't that have a lot of sulfur and isn't it hard to refine? And what about Chavez and his fight with the United States and selling the stuff to China?
Yeah, I mean, the Venezuelan crude is difficult to refine, and as a result, there are not many refineries around the world that can actually deal with it. I mean, I'm not a refining expert, but the ironic thing is that an awful lot of their crude oil has to come to the U.S. to be refined because it can't really go anywhere else, especially when you consider the transportation distances. From a political perspective, I think the real impact there will be how the Western oil companies react to the political conditions on the ground, and they've been changing the contract. They've been going making it more and more difficult for companies to stay the course in Venezuela. And if you back out the heavy unconventional crude oil that's been developed in Venezuela over the last few years, if you actually back that out, in fact, you see some pretty dramatic declines in Venezuela's conventional producing base that suggests a much smaller remaining reserve number in Venezuela than is conventional wisdom.
I was just up at NRCan, and there seems to be a huge focus in Canada on shale and hydrogen. And according to your comments, those are the two worst things you could possibly invest in. How do you explain all that shale stuff that's going on in Canada and the hydrogen focus?
Your comments on shale come as a surprise to me. I hadn't realized that NRCan in Ottawa was that focused on shale. I mean, it's really talked about a lot. People talk about tens of thousands of TCF of shale gas. But there really is virtually no production from shale in Canada at present. There's quite a bit of money that's spent on hydrogen, not anywhere near as much as in the US. And I, don't say that we shouldn't do it. Just that from what we know so far, if you look at the US National Academy of Sciences, they published a really good review of the hydrogen economy in 2004. And they indicated that, if you forget the fact that hydrogen is very difficult to store, it's hard to distribute. We make most of it from natural gas right now. We lose 30% of the energy in the gas when we turn it into hydrogen. If we use electricity, we lose 28% of the energy in the electricity to make hydrogen. So, from an efficiency standpoint, it's not there. From a fuel cell standpoint, it's not there either. So I would think that although I don't disagree that we have to keep looking at it, it's a mistake to think that the hydrogen economy is going to be here when we need it.
Just before the Gas Research Institute went out of business, it made an enormously bullish forecast on natural gas in the United States. And a lot of people consider that bullish forecast to be a lot of bull.
Well, I'd hope that I'd put the forecasts that are kind of publicly available out there, and then put some data out there as well that would allow you to have an informed opinion about how accurate those forecasts might be going forward.
In other words, your answer is yes.
Yeah, yes.
Michael Kane, Energy Affairs Editor with FromTheWilderness.com. My question is for Mr. Hughes. I'm under the impression that we don't know much about the decline rates of natural gas and natural gas fields. I might be incorrect, but I've heard about a natural gas cliff as opposed to peak oil, where you have a decline rate that can be on wells that can be predicted. From what I've gathered, I've been told and read that natural gas decline rates are very uncertain and can actually fall off a cliff and be very steep. Is that true? What understanding do we have of this? And if it is true, what does that tell us about the perils we're facing going forward with energy?
I've heard that as well. And what it may relate to, I mean, I showed you what's happening with the initial productivities of the wells. They're declining and declining and declining. And if they continue to decline, they may get to a point where it's uneconomic and people stop drilling. And if you stop drilling, then indeed you do fall off a cliff. For example, if you stop drilling in the US, you'd be down 28% next year, 28% of that the year after. So as soon as you hit that critical point in terms of economics and people stop drilling, that's what would cause a cliff.
This is a question primarily for Mike. In the graph you showed of plugging the gap of non-OPEC supply with unconventional oil, here's the question. What do you think the marginal cost curve looks like for, say, Canadian oil sands per barrel?
Well, that's a good question, and it's changing. And it's been changing pretty dramatically, primarily because of the cost escalation factors that we're seeing on the service side. The cost of drilling the cost of all your supplies, the cost of personnel. All of our costs across the board in the industry are going up, which is driving some of these marginal development costs up. If you go back and look at literature from just 2 or 3 years ago, they would tell you that in a lot of the Canadian oil sand developments, you know, you could profitably develop some of those projects at $20 to $25 a barrel. Some things have been published recently, although I haven't actually done any of the calculations, but I've seen things published recently that suggest that that marginal cost is now closer to 35. And that is all related to the cost of everything that goes into it: people, equipment, and natural gas.
One sec, I've got a quick question from Randy Udall. And that is, Mike, do your forecast by 2020 have any, include anything from shale, oil shale in the U.S.?
We do have a shale oil component in there, but it's relatively small. I mean, you see some forecasts that have numbers up into the several 100,000 barrels a day, but there are still a lot of significant environmental and technical challenges to overcome. You see a lot published on Shell's ICP technology and how that could eventually lead to substantial production. But it's a very slow process. There's still a lot of environmental challenges with it. And I've seen wide-ranging marginal costs of development for shale oil, but it's considerably higher than Canadian oil sands.
Mr. Hughes, I'm doing a documentary called Off the Grid, Sustainable Living, and you said something about the best alternative energy system or just design that you heard was in the coal and processing plants. But are you doing anything about co-op energy farming in your designs, or doing anything like techno fixes like water and solar thermal to make the hydrogen, because it's much more better for the energy invested on energy return, and then turning that hydrogen with the CO2 emissions from power plants to create like a liquid fuel called urea, or biodiesel with algae like the Israelis are doing? You ever think about interfacing new technologies to create more energy from different sources?
Actually, this is a little piece of a much larger analysis that I've done. And in my larger analysis, I've tried to look at, you know, realistic levels of contribution from some of the things that you've just talked about. You know, solar thermal, tidal, PV, wind, all of those things. My conclusion from that is they're all extremely important, but we really do have to reorganize the way we have set ourselves up. You know, we've set ourselves up to be really dependent on cheap energy. And looking forward, I mean, decades, that's not going to be the case. So we really have to not necessarily make sacrifices, but just reorganize so that we have a much lower energy footprint on the planet. That's.
Do you consider a national state of emergency energy issues right now?
A national state of emergency now? Yeah. I think you can see it on the horizon. And you know, one of my analysis in the bigger picture is global population, per capita consumption by country, per capita consumption growth, aspirations of growth in China, India. And it's a scary picture. You know, there's 34 million cars in China. There's 240 million cars in the US. But they have aspirations of having the same number of cars or more than we do. So, you know, the prognosis doesn't look good if we don't try to manage this going forward.
The projections for the energy value of methane hydrates vary a lot, but whatever the projection is, it's huge. And Dave, you basically gave a negative expectation on the return on energy investment. Do you think that is a permanent issue, that the energy is not recoverable, or is it a technical issue that, when solved, will open up that potential?
I think there's good gas hydrates and there's bad gas hydrates. You know, there's an energy pyramid for all forms of resources. Some of the gas hydrates that may work will be hydrates over a cap of conventional gas. You know, those types of deposits could be at the top of the pyramid. If you look at people's forecasts, I mean, Canada put a lot of money into gas hydrates. The Japanese spent $25 million at Malik in our Mackenzie Delta on gas hydrates. And the people who are experts on that project tell me that the soonest we're looking at a viable production technology is 15 years. So in fact, we could crack this with technology. Whether we'll ever unleash more than a small part of those huge tens of thousands of TCF estimates, I have my doubts. But I'd say it's a mistake to assume that gas hydrates will be here in 15 years. Let's start managing our problem now and hope for the best, right?
Question about Canadian oil sands. What are you anticipating as likely production levels, let's say in 2020 and longer term, and specifically water constraints and improvements to in situ technology to make it cheaper?
I'll just say that what we've done in our forecast through 2020 is basically stack up all of the planned projects, and there are quite a few of them, and we've put a pretty significant growth factor. I think our oil sands production gets up to about, I have to go back and look at the numbers exactly, but about 3 million barrels a day by the 2020. It's pretty much in line with some of the forecasts that have been coming out of Alberta. It's not inconsistent with what Canada has been forecasting.